Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and welcome back to our sessions that we're resuming again. I'm really looking forward to continuing our sessions Tuesday mornings to help you navigate the broader markets, because we have seen a substantial shift here over the past week or so with respect to equity markets finding a bit of a divergence here. Largely, equity markets have pretty much traded in lockstep with each other since April of last year. Starting to see a little bit of divergence, starting to see a little bit of bifurcation here. And the question is that bifurcation going to continue? Does that mean anything in terms of seeing this bifurcation? And how do we plan for this going forward in terms of our outlook? So that's what I want to discuss here today. Before we do, what we're going to discuss is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So I'll start off with our broader market update, taking a look at the major indices. Like I said, there's some bifurcation here. We want to identify that bifurcation, understand how that's going to play out. We'll take a look at sector rotation. We'll take a look at value versus growth. We'll take a look at sector rotation. We'll take a look at specific sectors that are showing some weakness here. And then we'll take a look at the full fixed income spectrum, what that may mean for us in terms of yields and rates and how that affects equity valuations, how that affects commodities. And then we'll take a look at some of the updates from the labor markets before we share with you some of our ideas based on everything that we're discussing here today. But the primary question that I want to help investors answer is a question that we've been receiving here a lot over the past couple of days, which is, can we expect further market weakness? Or is the pullback that we're currently seeing in the equity markets a buying opportunity? So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical charts, my economic research, my statistical research that helps inform my decisions in the broader markets based on the things that we're going to discuss here today. So if we start with the S&P 500, we continue to talk about this very strong uptrend that we see here on the weekly chart. If we zoom into the daily chart, we start to see some levels of exhaustion where we push higher highs in price, but as you can see, momentum's no longer confirming that high and is actually making a lower high. This type of divergence typically shows us that there's a higher probability of a pullback here. And largely what we have here is a bit of a double top here, if you want to call it that, in terms of SPY. That certainly has spent quite a bit of time here, pretty much since late March, above the 21-day moving average and has not fallen below that level here. So today, and perhaps over the next few trading sessions, we may see this move down below the 21-day moving average. Only below those levels would we consider thinking about looking for buying opportunities. As long as we remain above that level, I think I'm more inclined to be taking profits and looking potentially even for shorting opportunities. But when we look at the NASDAQ 100 index, this is that bifurcation I'm talking about. We had this double top here form on the NASDAQ 100, which largely coincides with the late February, mid-February highs. And we've now started to turn to the downside here. Now to the downside, you have support roughly around the 320 level, but some bigger support here around the 310 level. So as we look at tech names that are starting to get weaker and weaker, and part of a lot of the shorts that I've been taking here over the past few weeks have been only been in the tech name. This leads me to believe that there is potentially some further downside here in the higher beta tech names, and we'll even drill down into specifics that may show even further weakness than the NASDAQ 100 index, which is still a fairly broad-based index. If you look at the IWM small caps, after a very strong move here to the upside from November, we've been doing nothing except for consolidating here over the past 3 months or so, and we're still just right smack in the middle of that consolidation range. There's not a whole lot of directional view here. You want to call it perhaps a triangle or a rectangle. Right now looking like it's targeting the bottom of that triangle or a rectangle. And the question is whether we see a break below that level, which would suggest further downside, or if we simply bounce off this level and continue this range bound level here. So this is really some of the major indices trading near some major support levels that we really have to pay attention to. That's going to help us answer that question, if this is a buying opportunity or if there is further weakness here in the broader markets. The one one, I would say, bright spot in the broader markets is RSP, which is the equal weight S&P 500 index. So far looking fairly resilient and fairly strong. This is showing us that the weakness is coming largely from the mega cap names, and it's actually the smaller cap, the broad-based S&P 500 index that actually remains fairly strong. The outperformance of the market is coming from the smaller segment or the smaller spectrum of the S&P 500 names. And this is interesting because this is the bifurcation and the weakness that we're starting to see. The S&P 500 performing actually quite well and showing quite a bit of resiliency, while the higher beta tech names showing quite a bit of weakness here. And it's not just tech names. We're also seeing it in some of the travel stocks, some of the reopening stocks. These are all parts of the market right now that are seeing some losing some ground here. But the big theme that still remains, and for those of you that have followed me for a while here, is value versus growth. We've talked about how value has underperformed growth for many, many years. But for the past 10 months or so, value has put in this bottoming formation and has started to break out higher here. And what's really amazing is to see is that the breakout here came back to retest this level as support and is now bouncing higher. This is a zoomed in chart here of that breakout level. This is where value started to outperform growth here in mid-February. Came back to retest this level literally to the penny in early April, and has only continued to outperform here growth here. This confirms this bottoming formation here of value to growth. This really suggests that value will continue to outperform growth going forward. So especially as you're looking for opportunities here in the broader markets and you're thinking to yourself, all of these tech names that have sold off, the best performing stocks late last year, are these buying opportunities for these stocks, or is it time to reposition? And from my perspective, looking at these charts, it suggests that this is not a buying opportunity for these tech stocks. It's more of a time to rotate into value, rotate into smaller cap, as we start to see the performance of these sectors outperform the higher beta tech names. And we look at sector rotation here. Look at the stocks, look at the sectors that are outperforming: financials, materials, industrials, energy. These are not what I would consider high beta tech names, right? These are not the stocks that are performing. The higher beta tech names, technology, consumer discretionary, healthcare, real estate, all either weakening or getting back into the lagging category. And then the leading categories or the improving categories are consumer staples, as you can see, communications attempted to get into the leading category, but is starting to fail a little bit there. And then you have healthcare, real estate also going into the weakening category. Utilities starting to come a little bit to life here, but still in the lagging category here. So as you're looking for opportunities, remember to continue looking at names like financials, materials, industrials. That's where I would pay attention to. Consumer staples, very strong sector coming up into the leading category. Energy has led quite a bit here, so I would be a little weary to see if this starts to come down as well. So be careful. Energy's strong outperformance is certainly interesting to pay attention to, but I'm not sure how much longer that can last. So, and then if we look at, if we dive down even further within the sector rotation, when you specifically look at the very high beta, unprofitable names, largely in this ARK ETF, the one thing I will point out here is ARK recently broke below the 200-day moving average and also broke below this double bottom support here around 110, or what you would consider a triple bottom 110 here. This certainly puts ARK substantially in a weaker spot and likely to retest this $90 support level here to the downside. So when you ask, is it time to buy these higher beta tech names? I think there's a little bit more downside here to some of those names than a buying opportunity just yet. And some of that evidence and some of that view, some of that view is extrapolated from our views on interest rates. So this is the 10-year yield. We haven't talked a lot about the 10-year yield recently because after having such a strong move here in February to April, it largely has consolidated here over the past past month or so, month and a half. So it hasn't had a squeeze on valuations like we first saw back in February. But as you can see, it has found some support here around this 155, 160 basis point level, finding some
support, and potentially now ready to rise a little higher here to that 170, 175 basis point level. And this is not just based on technicals, because usually we don't apply a lot of technicals to interest rates. Interest rates are usually driven by more monetary and more economic policies. But the one thing that we can, likely are fixed income bonds. So when we look at TLT, so TLT has underperformed significantly this past year in terms of treasuries. And this is, generally speaking, a good thing from an economics perspective, because when you see treasuries sell off, that means that investors are ready to take on risk. They're going to sell off riskless assets like treasuries and buy riskier assets. However, this also has some concerns around interest rates. So we've had this sell-off here in TLT that accelerated back into mid-April or mid-March. We've now had a period of consolidation here, or what you would call a flag or pendant formation, and we're starting to potentially retest this level here to the downside. Now, if we start to see a breakout here to the downside, that would project a fairly sizable move here to the downside from a continuation pattern perspective, because you basically had a move from about 154, 155 down to the 137 level here or so. So you're talking about a fairly sizable move, and we would use that to project moves here to the downside. Remember, bonds are inverted to yield. So if you have a significant sell-off in bonds, that's going to rise. That's going to have a significant rise in yields. And we're not seeing this just from treasuries. We're seeing the same thing from LQD, which is investment grade bonds. We've had a sell-off here in investment grade bonds, a long period of, I would say, consolidation or continuation, and then a potential breakdown here. Now, the one thing I will say is that these fixed income products have not broken down yet, but this is one to pay attention to, because if you do see that breakdown, that's likely going to cause a significant rise in yields, and that is likely going to put further compression on these higher beta, non-profitable tech stocks, and consumer discretionary stocks, any type of stocks, even some of the airlines and the hotels, reopening trades that are trading at what I would consider very, very rich valuations compared to where they were trading prior to the pandemic, literally priced to perfection, if you will. Those are the names that you're going to see some downside as yields continue to rise. And high yield, this is the furthest, riskiest side of the spectrum when it comes to fixed income, also failing to break out to new all-time highs after the move here to the downside. This is losing quite a bit of momentum here, as high yield is still the best performing out of the bonds, but starting to lose some of that momentum here, and potentially starting to shift some of that momentum here to the downside, which again, when we see this shift across all three risk spectrums, that's a concern here for me. Now, when we look at GLD is now reaching what I would consider a fairly sizable resistance level. However you want to take a look at it, you have the 200-day moving average, and then you have this bearish trend line coming in. So GLD remains in this strong downtrend here if we look at this on a daily chart, or if you want to look at this on a weekly chart, however you want to draw this. This could be interpreted a few different ways. If you see this as a continuation of this downtrend, this was a potential shorting opportunity, but you could also view this as a long-term bullish trend here for gold, a period of consolidation or rest, and now it's going to continue moving higher here. Regardless, we're at a pretty pivotal moment here. And this is the 172, 173 resistance level here around the 200-day moving average. As you can see, the 200-day has pretty much been flat. And the question is whether gold breaks out higher here or not. With inflation expectations, it's very possible that we do see that breakout here in gold. And if that's the case, I would target this 182.5 highs here to the upside. As a potential move here to the upside. So after forming this bottoming formation here on gold, potentially breaking out higher here, which would line up with the rise in yields. So when we take a look at the economic side of things, this is really where the April numbers surprised substantially here to the downside. Survey what expectations was non-farm payroll to add about 1 million jobs, came in at a very, very weak number in comparison to that, only adding 266,000 jobs. The only bright spot out of that entire jobs report is that most of the hiring came out of leisure and hospitality. This is the one part of the market that has been very weak with respect to wages and respect to employment. So seeing gains here in this specific segment of the market or sector of the market is relatively a positive and speaks to the shape of the economic recovery, if you will. But pretty much all around, this was a very, very weak jobs report for April. And it speaks to the stubbornness of the unemployment rate that we're starting to see, or the lack of the bifurcation that we're starting to see between applications and job openings. There's a huge gap right now between available jobs and people applying for those jobs. This is causing labor inflation, substantial labor inflation across manufacturing, services, and quite a few other industries. This is leading to higher labor costs. This is leading to, and when you put that in conjunction with higher raw material costs, this is going to put a substantial potential catalyst, if you will, for inflationary concerns. We've seen an 800% increase in S&P 500 companies concerned about inflation during their earnings calls. That we've never seen anything like this over the past 2 decades in terms of S&P 500 companies concerned about inflation. And it's not just one-sided; it's labor and raw material goods. So this will likely show up in inflation numbers. This will likely trickle down into consumer goods in terms of the price that we have to pay for consumer goods. And this is going to have some effects on quite a few different industries, whether we're talking about consumer discretionary, consumer staple names where they are very sensitive to labor and price inflation, or industrial companies that specialize in automation. When you have strong moves in labor costs, that usually is a driver of automation and driver of moving away from labor-intensive sectors. So these are things that we really have to pay attention to, because this is one very strong risk, in my opinion, to the rally that we see in equities right now. And I think markets are already pricing that in based on the weakness that we've seen in the broader markets. So when we look at the services PMI, this is really, again, one of the sectors of the markets that we need to see strength here. And both market and the ISM services PMI so far continuing to surprise to the upside. ISM a little weaker than the market numbers, but largely we're seeing gains here from the services side of the economy. And that, again, is the bare minimum that we need to keep this rally afloat, is seeing both manufacturing and services continue to rebound. So far, services coming in okay, but again, further weakness here in this specific part of the market, especially if we start to see a weakness on manufacturing. That is the major risk that I see here with the current equity rally that we have. So when we look at opportunities here in the broader markets, we really, again, we've seen this bifurcation here in the market. So we have to also look for bifurcated opportunities here as well. So Parker Hannifin is an interesting name in the industrial space because they specifically deal with manufacturing and automation. And this is one part of the market that is still remaining very strong, especially with inflation expectations being so strong here. Companies are likely going to invest in automation and manufacturing over the labor costs. They're finding it more and more difficult to hire workers. So what are they going to do? They're forced to move to automation. And then you combine that with the fact that the global supply chain has been largely disrupted due to COVID, and you have a lot of U.S. companies moving manufacturing back onshore. So companies like Rockwell Automation and Parker Hannifin are the ones that are likely going to benefit from that, because they produce a lot of the manufacturing machinery, if you will, to produce that. So Rockwell Automation, Parker Hannifin, these are some of my top picks with respect to the surge that we've seen in terms of industrial stocks. And staple stocks as well, Procter & Gamble. Procter & Gamble recently, similar to Parker Hannifin, recently showing quite a bit of strength here, had a bit of a downturn, but as you can see, broke that downtrend here, came back to retest this level of support, and has a potential breakout here to the upside. Looking at Procter & Gamble in the staple space, so as I was showing you on that sector rotation, staples, one of the sectors showing quite a bit of strength here. And then on the flip side, looking for weakness within those higher beta names. You know, we've been talking about chip shortages for quite some time, but we're seeing quite a weakness we're starting to see quite a bit of weakness from many of the chip manufacturers. Whether this is due to chip shortages, I doubt that it's actually due to chip shortages, but that's certainly one of the things that is pressuring some of these chip stocks. But also, I think there's also some concerns now about just the amount of capacity that chip manufacturers are trying to add that is likely going to actually create too much supply versus the amount of demand we expect here over the next couple of years, because there has been major investments in terms of capacity for chips over the past 6 months or so, many of them coming out in the past couple of months. So there's some concern that basically we're going to start producing more chips than we can actually consume. So we're starting to see a bit of weakness from many of the chip stocks. Micron, one of the things about Micron is that we're seeing a fairly strong amount of exhaustion. As you can see, higher highs in price pretty much since the $72 level has been shown with higher and higher degrees of exhaustion or divergence, as you have higher highs in price, lower highs in momentum, and now we have a breakdown below some support levels here around this 82 and a half level here. And this would target, in my opinion, down to this $70 level, which corresponds with the 200-day moving average. So when you look at some of these names like Micron, starting to see a bit of weakness, and we're seeing this across the board with respect to chip manufacturers and some of the foundry type companies. And lastly, another segment of the market in consumer discretionary that is again also priced a bit to perfection is some of these hotel and casino stocks. MGM, we've already seen some downside here for names that have reported like Marriott, but we've also seen a fair amount of margin compression, multiple compression from gaming stocks like DraftKings, Penn National. These types of stocks that were trading at very rich valuations are starting to come in. So MGM kind of sits at the intersection of both of these sections, where you have hotel operators as well as online gaming with respect to sports betting. Seeing some multiple contraction here. This is the same negative divergence that we've seen here in some of the tech names here, as higher highs in price are combined with lower highs in momentum, and this potentially puts some downside pressure here in some of these names down to this, in MGM's case, down to about $32 here to the downside. So quite a bit of opportunity both on the upside and to the downside. I will say this particular quarter, we've seen a substantial shift where most of that opportunity is to the downside, whether many of them coming from tech names, specifically higher beta tech names that are not profitable and not growing very strongly. Think about Fastly, Etsy, Palantir, Netflix, Intel, these types of names that trade at relatively rich valuations that are not growing very fast, are not very profitable. Those are some of the names that we've seen the most downside. So keep your eyes out on this particular market. I do think that there's more downside for many of these higher beta tech names. There's limited names that still have some upside in the industrial, in the consumer staples space, but there's certainly been a shift here in the broader markets, and make sure that you position yourself correctly for this shift. So with that, thank you so much. I hope that this helps you, give you some insights into how I'm viewing the markets and how I'm positioning within this particular market. And I hope that I'll see you guys here next week. Thank you so much and have a great trading day.